Hi, everyone. It's Peter Schiff. It is Saturday, September 21st, 2013. On Wednesday, the Federal Reserve did exactly what I've been saying they would do ever since they first outlined their so-called timetable for tapering back or bringing to an end a quantitative easing. They didn't do anything on Wednesday. They left their quantitative easing exactly the same, $85 billion per month, 45 billion treasuries, 40 billion of mortgage-backed securities. In fact, if you look at the net buying, the Fed is actually buying more than 90 billion a month in these securities because it is also reinvesting all the interest it earns by holding these securities into brand new securities. The last video blog I did, I kind of laid out a rationale for why the Federal Reserve might surprise me and actually taper, even though I believe it never intended to do so. I thought maybe it would have felt that it had kind of boxed itself into a corner because just about everybody expected the Fed to taper. And I thought maybe they would try to have their cake and eat it too and come out with a taper light. I mean, just do the bare minimum and then try to defuse expectations that more tightening or a deeper taper was imminent. But I guess the Fed was more concerned about the economic damage from a taper, even a slight taper, than the psychological damage of not tapering at all. After all, I thought that the Fed might be worried about the mixed signals or the mixed message that it was sending. Because if the Fed was so concerned about the fragile nature of this recovery that it didn't even think it could handle a mere 75 billion a month of quantitative easing, then people might begin to question whether or not the U.S. economy really is recovering. And I think the Fed is very concerned about managing expectations. After all, the asset bubbles that it's inflating, psychology is a big part of it. Most people actually believe we have a legitimate recovery, that the recovery can be sustained even without the Fed's stimulus. So they are, waiting for the Fed to dial it back. Now, I suppose this was a concern because when the Fed surprised Wall Street and didn't do what they expected, which was tapering, the markets reacted violently, particularly the currency markets, the commodity markets, and gold. Gold was down about $20 in evening trading. Everybody was getting ready for the taper. And when the Fed didn't taper, gold erased that loss and rose another $50 or $60. It was a huge move. Also, the dollar was down across the board. Oil was up better than $2. And the stock market did rally, although it wasn't, that big a rally. It was up, I think, slightly over 100 points because I think that the exuberance over the lack of a taper was tempered by the fact that, wait a minute, if they're not tapering, maybe the economy isn't as strong as we thought. And in fact, during the entire day of Wednesday afternoon and all through Thursday, everybody in the financial community was beginning to wonder about the economy. What does the Fed know that we don't? In fact, I think the Fed was so concerned about doing damage control that they sent James Bullard out to do an interview, who is the president of the Federal Reserve Bank of St. Louis. He came out and he basically went out to put some spin on it, to do some damage control. In other words, he came out to lie. And what he said was that, we almost tapered. It was a real close call, and we didn't taper, but you know what? We might do it in October. And that was all the markets needed. And then you had a big sell-off in gold. Gold dropped about $40. All of it based on the idea that, wait a minute, maybe the Fed is going to taper after all. But it's all BS. They're not going to taper. First of all, Bullard said it was a close call, that they almost tapered. The vote to not taper was 9-1. Yeah, a real nail biter that one was, a squeaker. But, Bullard himself voted with the majority. He voted not to taper, as did Janet Yellen, who is most likely to be the chairman of the Federal Reserve after Ben Bernankes steps down. And of course, what does he mean? They're going to taper in October. Why? I mean, what's going to change? In fact, Ben Bernanke gave a press conference after the announcement of a no taper to explain the Fed's inaction. And Ben Bernanke went over a whole list of things to describe why the U.S. economy was not strong enough for a taper. Well, how is that going to change in 4 weeks? It's not. Nothing's going to change. If the Fed was going to taper, they would have done it in September, not wait till October. Everybody was ready for a taper. The markets were prepared for a taper. All they had to do is deliver on those expectations. The fact that they didn't do it means they had no intention of doing it. But again, they got to do damage control. They got to pretend that they can actually taper, even though it's impossible. And in fact, Ben Bernanke gave a clue as to why it's impossible when he, had his press conference. The main reason that he stated that he didn't taper was because financial conditions had tightened. Those are his words. Financial conditions tightened. Now, what is he talking about? What financial conditions tightened? Well, interest rates went up. That's what happened. He's talking about the increase in interest rates, particularly the long end of the bond market, and of course, mortgage rates, which threaten the housing market. So Ben Bernanke said, because interest rates have gone up, we can't taper, because he said he didn't want to tighten the conditions any further than they had already tightened. But the important thing is, why did financial conditions tighten? Why did interest rates rise? Because Ben Bernanke said he was going to taper. He said he was going to bring quantitative easing to an end by mid-2014. The only reason interest rates were as low as they were was because of quantitative easing. In fact, Ben Bernanke said the reason for quantitative easing is to bring down long-term interest rates. So the Fed is going to enter the market buying all these bonds to artificially suppress interest rates. Now he says we're going to stop doing that. Well, it only makes sense that interest rates would rise. After all, he's not going to do the action that was suppressing them. But now Ben Bernanke says because interest rates went up, we can't taper. But of course, if you're going to taper, interest rates have to go up. But if Ben Bernanke is going to say we'll only taper if interest rates stay low, well, then he's admitting that the Fed can never taper. Because you can't have your cake and eat it too. If you taper, interest rates go up. If you end quantitative easing, interest rates go way up. If you try to shrink your balance sheet, interest rates skyrocket. But if the Fed wants to keep interest rates at rock bottom levels, which it clearly does, to try to revive the economy and sustain these asset bubbles, the stock market and the real estate market, then he can never taper. And if he couldn't taper in September, he surely can't taper in October. Yet Bullard was out there again to BS the markets, and they bought it hook, line, and sinker. But you know what else this guy had the nerve to say in that interview? He went on to praise the Federal Reserve for its QE. He was basically talking about what a success it was at helping the economy, and then he went on to say that it didn't create any asset bubbles. What is he talking about? And then listen to this. I'm going to read this quote because I don't want to get it wrong. Here is what he says, quote, as he's saying that there's no asset bubbles now. He said, quote, the bubbles we had in the past were gigantic and obvious. I don't see anything like that going on right now. What is he talking about? Yes, they were gigantic. I'll give him that. But obvious? To the Fed? I mean, they might have been obvious to me and a few other people, but they weren't obvious to anybody at the Federal Reserve. Yes, they were gigantic, but not only weren't they obvious, but members of the Federal Reserve denied that these bubbles existed. Ben Bernanke himself, as late as 2008, said there was no housing bubble. Even as people were trying to make the point that there was a housing bubble, people were questioning Ben Bernanke about a housing bubble. He said there wasn't a housing bubble. Well, it was gigantic, according to Bullard, yet Bernanke couldn't see it, and neither could he. In fact, Alan Greenspan, during the height of the NASDAQ bubble, when he was questioned about whether or not there was a bubble, he said, well, we don't know. You can never tell a bubble until after it pops. Now, of course, that's not true because that bubble was obvious too, but the Fed didn't see it. It can only see bubbles in hindsight. That's what Alan Greenspan said. We can tell there's a bubble after it burst. The only reason that the housing bubble is now obvious to Bullard and anybody else at the Fed is because it already burst. Now, if the Fed can only see a gigantic bubble after it bursts, how does Bullard know that there's no bubbles now? And of course, it's almost an admission when he talks about the fact that we don't have a bubble now based on the Fed's policy, but he admits we had a gigantic bubble in the past. That's because of the Fed policy. So he's basically saying we screwed up last time. We kept interest rates too low and we inflated a gigantic housing bubble. That was obvious. But now our monetary policy hasn't inflated any bubbles. Well, sure it has, because the bubbles they can't see now are just as gigantic, but yet they're not obvious at all to the Fed. Now, is it possible that the bubbles were obvious and they just lied about it? I guess that's true. Maybe Bullard did see a housing bubble because it was so gigantic. How could he have missed it? But he kept his mouth shut, just like everybody else at the Fed. So now maybe he sees another bubble that's even bigger than the one that he saw back then, but he's lying about it, just like he did back then, because it's one or the other. Because if it was obvious to the Fed, then they lied about it because they didn't tell anybody that they could see it, or they weren't obvious, in which case the Fed has no clue. Bullard has no clue whether or not there's a bubble in assets, whether it's stocks or real estate. And it's not just these government officials that were out talking up the Fed. Warren Buffett again comes to the rescue with some of his own PR. Warren Buffett basically came out and praised the Federal Reserve this week and said the Federal Reserve is the greatest hedge fund in history. Greatest hedge fund in history. Why would he say that? Well, because he said they're making about $80 to $90 billion a year off of their $3 trillion balance sheet. That's why they're so great. Well, first of all, that's a return of less than 3% a year on their portfolio. I mean, is that really the greatest hedge fund ever? I mean, would a hedge fund manager be bragging about the fact that they can almost eke out a 3% return? I mean, would they really be lining up to pour money into that kind of a hedge fund? No. But what Warren Buffett doesn't understand is the enormity of the risk that the Fed is taking to eke out that meager, not even 3% return. And proof that he doesn't understand it, here's another quote from Warren Buffett. He said that the Fed is under no pressure, none whatsoever, to have to deleverage. Now, what does that mean? Because he's thinking that they've got all this debt and they never have to worry about it, like a private hedge fund that doesn't control interest rates. Well, neither does the Fed. I mean, what would the Fed have to do if the official measures of inflation were to rise above its ceiling, it's 2.5%? Or what if unemployment actually went down? Right? Some people think that might happen. Or what if GDP growth was actually as high as what the Fed claims it's going to be? Wouldn't the Fed then have to raise interest rates? Wouldn't it be under pressure to deleverage? Right? Wouldn't it have to start tapering? Wouldn't it have to start winding down its balance sheet? Because if it did that and interest rates went up, the Fed would lose hundreds of billions of dollars on its portfolio. It would be the biggest blow up of a hedge fund in history. That's what it would be. And the problem is, we, the taxpayers, would have to absorb all the losses, even though we didn't voluntarily invest in this hedge fund. Now, Warren Buffett is saying, well, the Fed doesn't have to do that. It doesn't. In fact, that's why I think they know they can't taper, because they don't want to blow up their balance sheet. They have to keep interest rates at rock bottom. Even if inflation picks up, they can't do anything, which is one of the reasons, or the main reason, they have to lie and pretend there is no inflation, because they can't fight it. Because if interest rates go up, not only do they plunge the U.S. economy into a severe recession, worse than 2008, but they destroy their own balance sheet. They're going to lose hundreds of billions of dollars. They're going to have to send a fat bill to the Treasury. Right now, Warren Buffett is happy about the fact that they're sending the profits to the Treasury. Well, they're ultimately going to have to send a big bill. I mean, maybe it's kind of like Warren Buffett thinks that Ben Bernanke, he's playing this Blackjack system, the double down. There's a system of Blackjack. Of course, it doesn't work, but you make a bet, and if you lose, you just double up. And then if you lose again, you double up again. And every time you lose, you just double your bet because eventually you're bound to win and then you get all your money back, right? Well, the problem with that theory is that eventually you run into the table limit and you can't do it anymore. And then you lose. And the bigger problem is, let's say you start out with a $5 bet. And by the time you hit the table limit, you're at $5,000. And you got $5,000 in front of you. And all you're trying to do is break even. It's all your money on the table. It doesn't even matter to the house if you win because you're not going to win anything. You're just getting your own money back that you've already lost. So it's a very, very risky strategy. You take a lot of risk for a meager return. That's what the Federal Reserve has done. That's the greatest hedge fund in history. They take enormous risk for a tiny return. And then Warren Buffett wants to praise them for doing it. Now, of course, I got to say something in this video blog about President Obama and the new showdown over the debt ceiling, which, of course, now there's a lot of political posturing going on, as always is. It's all politics. Nothing's going to happen. The debt ceiling is going to be raised. All the spending is going to take place. Right now it's just a theater. And, of course, the best thing that can happen would be that we don't raise the debt ceiling and we actually deal with the problem, but that ain't going to happen. But listen to some of the things that the president was saying in his most recent speech. He said, quote, "If we do not raise the debt ceiling, America cannot pay its bills." See, he's got it wrong. We can't pay our bills. That's why we have to raise the debt ceiling. We raise the debt ceiling so we can borrow money instead of paying our bills. I don't know why nobody else in the mainstream media can figure this out. They don't know the difference between paying your bills and borrowing money because you can't afford to pay your bills. He said that this is not a banana republic. We don't run out on our tabs. We can't just not pay our bills, but that's exactly what we do. We have a $17 trillion national debt because we have $17 trillion worth of bills that we haven't paid. What do you mean we just can't run out? That's all we do. We dine and ditch. We don't pay anybody anything. Yes, so long as we can borrow money, okay, great, we'll do that. But we can't pay our bills. He also said that if Congress doesn't act to raise the debt limit, we can have another financial crisis. Well, it's not that we could have another financial crisis. We would have another financial crisis. And why would we? Because then we would have to deal with the bills that we can't pay. Because if we can't borrow more money to avoid paying our bills, then we have to deal with the bills. And since we can't pay them, there would be a financial crisis. So the financial crisis is inevitable because eventually it's not going to matter whether or not we raise the debt ceiling because the debt ceiling is self-imposed. That's our own limit on how much we're willing to borrow. But it takes two to tango. See, the lenders have to decide that they want to keep lending. And of course, what's the point of lending money to somebody who can't pay you back? Now, eventually, if the Fed doesn't raise interest rates, because it can't, to levels that will compensate our bondholders for the loss of purchasing power in the dollar as a result of all the money they're printing to keep interest rates artificially low, if they don't want to do it, then they don't want to roll over the debt. And then they've imposed the lending standard. And then we're going to have to deal with the bills that we can't pay. And how do we deal with them? Either we default, right? The government just admits it can't pay, and we default anyway on the national debt. See, right now the president's saying if we don't raise the debt ceiling, we're going to default. What he's saying is if we can't borrow more money, we can't pay back the money we've already borrowed. Well, that's going to happen eventually anyway. So we're going to have to default, not just on the bondholders, but on all sorts of commitments that have been made by the government to everybody in exchange for their votes. And yes, it will be a financial crisis, much, much worse than the financial crisis of 2008. Of course, if the Fed tries to avoid that crisis by printing indefinitely, by buying up all the bonds that nobody else wants. Yes, we raise the debt ceiling, but the only one willing to lend to the U.S. government is the Fed itself, and the Fed is buying all the bonds. And then, of course, it's not just going to be treasuries. It's going to be buying all the mortgages, the corporates, the muni bonds. No one's going to want to buy any low-yielding U.S. dollar-denominated debt. Then we have a currency collapse. We have runaway inflation, And that economic crisis, not only is it much, much worse than 2008, it's also much worse than the one that we would have had they simply defaulted and not resorted to the unlimited quantitative easing. That's it for now. Again, keep listening to schiffradio.com for daily updates on what's going on with the Fed, in the economy, and with the markets. Thanks for listening.